Today we're breaking down S&P Global, ticker SPGI, a company that quietly powers global financial markets. If a government issues bonds, or a company issues debt, or if you invest in an ETF tracking the S&P 500, SPGI is involved. They do three core things. They rate companies and governments on how risky their debt is. They create and license major stock indices like the S&P 500. And they sell financial data, analytics, and commodity pricing to institutions. This isn't a consumer brand, but it sits behind the scenes of trillions of dollars moving through global markets. I'm Edward Kalstian, founder of Ag Capital, where we look for market-beating stocks for the long run. In this video, we'll analyze SPGI using our 5 key factors: economic moat, returns on capital, growth, financial strength, and valuation. Now let's start with the moat. SPGI's moat is real and it's multi-layered. First, in credit ratings, it operates in a regulated oligopoly alongside Moody's Corporation. Barriers to entry are extremely high due to regulatory recognition, reputation, and decades of trust. Second, its index business benefits from structural tailwinds. ETFs and passive investing rely heavily on S&P indices. Once an index becomes the benchmark, it tends to stay that way. Third, its data and analytics products are deeply embedded into institutional workflows. These are subscription-based recurring revenue streams. Switching costs aren't as dramatic as ERP systems, but they are meaningful. Overall, SPGI is a strong moat, driven by regulation, brand trust, and recurring subscription revenues. Now we test whether that moat translates into real returns. On a standalone basis, return on invested capital is 8.7% and declining since 2021. Return on equity sits at 13.1% and is also declining. So why the drop? In 2021, equity increased dramatically from $5.5 billion in 2020 to $39.7 billion in 2021. This was primarily due to the IHS Markit acquisition, which significantly expanded the balance sheet and capital base. When invested capital jumps sharply, returns mechanically decline, at least temporarily, until earnings catch up. So part of the return on invested capital compression is structural, not necessarily operational deterioration. Now, if we compare SPGI to peers looking first at return on invested capital, Moody's stands at 19.5%, MSCI at 29.7%, and FactSet at 17.8%. SPGI clearly trails peers here. Now looking at return on equity, Moody's stands at 57.2%, FactSet at 29.1%, and MSCI at minus 66.9%, which is distorted by aggressive buybacks, reducing equity. SPGI returns are healthy, but not elite relative to peers. That's something to watch. The next step is the translation from returns on capital to growth. Over the last 10 years, revenue grew at a compounded annual growth rate of 11.7%, net income grew at a CAGR of 8.9%, and earnings per share grew at a CAGR of 7%. One important observation is that earnings per share growth is lower than net income growth. This is due to the IHS Markit acquisition-related equity expansion. Higher shares outstanding reduces earnings per share. Now compared to peers, for earnings per share growth, Moody's stands at 30.2%, MSCI at 21.6%, and FactSet at 7.4%. SPGI sits between the hyper-efficient compounding of Moody's and MSCI and the steadier profile FactSet. This is solid growth, but not explosive. Growth is only sustainable if the company has healthy financials. Now looking at the balance sheet, cash sits at $1.8 billion, total debt at $13.6 billion, so they can't fully cover their debt with cash. Free cash flow sits at $5.5 billion, which gives us a free cash flow to total debt ratio of 40.4%. Anything above 10% is considered acceptable, above 30% is strong. This confirms controlled leverage, strong cash generation, and financial flexibility. SPGI is not overextended. Even the greatest companies can be poor investments when investors overpay. So how is SPGI valued today? SPGI trades at a forward price-to-earnings ratio of 21.1. Compared to peers, MSCI sits at 26.8, Moody's at 26.4 and FactSet at 10.7. So SPGI trades below MSCI and Moody's but above FactSet. Now let's take growth into account by looking at the PEG ratio. Analysts expect 15% long-term earnings per share growth for SPGI. This gives us a forward PEG ratio of 1.4. which is reasonable. Now let's anchor this to history. Trailing price to earnings for SPGI is 28.1 and the historical earnings per share CAGR is 7%. This gives us a trailing PEG ratio of 4. That's a big difference. If the 15% earnings growth forecast materializes, valuation looks fair. If growth stays near historical 7%, returns could be very modest. Expectations matter. So let's bring this together to our 5 key factors. SPGI is a strong moat built on regulation and recurring data revenue. Returns on capital have fallen since the IHS market acquisition and now trail key peers. Revenue growth has been solid at 11%, but earnings per share growth at 7% is something to watch. Financial strength is healthy, with strong free cash flow and manageable debt. Valuation looks reasonable if 15% expected growth materializes, but expensive if history repeats. SPGI is a high-quality financial infrastructure business. The question is simple: is this a temporary reset, or will we see lower future returns?